So this video is designed for those times when the market really takes a temporary hit and you're told by whatever you see or read or by your advisor that it's probably wisest to stay put. In other words, don't make rash decisions because it's hard to know when the market's going to get back up again. But is there anything else you should be thinking about? Well, I've got two ideas today that may apply to some of you. So let's look at them. The first one has to do with buying on the dip. Now, we really never know when the bottom of that dip is, but it's reasonable to say that if the markets have gone down substantially and you are a long-term investor, if you were to buy during a lower point, you'd probably get a better bang for your buck than you would have if you had purchased a while back before the markets did go down. Another way to think about that is dollar cost averaging, meaning maybe you don't want to buy all at once, but put some money to work periodically, once a week, once a month, until you get the amount that you can invested, and it'll probably be on average at a pretty efficient price versus trying to guess the right day. The other strategy is a Roth conversion, timing a Roth conversion. And by timing, I don't mean trying to time the market. I mean the fact that if you had funds in an IRA that would be nicer to have growing tax-free for you, and you converted those funds into a Roth IRA, they will in the future grow tax-deferred and be tax-free, but you do pay tax on the amount, the value that you convert. So if you had a number of shares in a mutual fund that were at a higher value and they have temporarily dropped to a lower value, you converted at that time, you have the same amount of shares going into your Roth IRA. Hopefully, if it follows past trends, things go down and then they would go up. If it responds like it has in the past, you would have paid tax on the lower value of the shares at that time. So while you or someone's going to pay tax on IRA money at some point, does it make sense to lock in, if you will, a tax on a lower value, and then as it appreciates and you get that tax-free in years to come, you've taken that tax burden away by a little bit anyway. You have in effect timed your Roth conversion. So while these times when markets are down definitely aren't fun, and for the most part you should not make rash decisions, and if you are an investor you should hang on for the long haul. If you're very uncomfortable with where you're at, think about that the next time things appreciate. Maybe you should be in a little bit different situation, but during those times, if you have the opportunity for these two strategies, it may benefit you.